my recollection anyway, was that we pretty much left off at, well, if we're auditing revenue in chapter 10, that's what we were learning, then we should think about auditing related accounts at the same time, simultaneously. So generally, the credit is to what? Sales. The debit could either be to cash, and we talked a little bit about controls over cash and whatnot, but then the debit could also be, if we offer credit sales, and most companies do, of course, then the debit could be to accounts receivable. So while we're getting information to audit sales, well, we can get some information that'll help us to audit accounts receivable. And while we're auditing accounts receivable, we get information that is helpful to help us to audit the revenue. So we're going to talk about auditing accounts receivable in this chapter here, where we're talking about auditing revenue. Okay. And I'm going to, sorry guys, I don't mean to be so annoying here, but I never seem to remember to clean my glasses until the class starts. So forgive me for making you watch me. And I can't see without my glasses. Don't get old, is all I can tell you. You want to avoid this kind of stuff. Okay. All right. So let's go ahead and let's take a look at this slide here on auditing accounts receivable. And remember, and I've put this little graphic up a few times, that if this is my substantive procedure, this rectangle represents my substantive procedure, my substantive testing, whatever. Okay, then I could have quite a bit of this rectangle filled in as test of details. Sorry, buddy, I'm going to draw over your face. As test of details, okay? And then what? I can have some of this filled in. These lines are supposed to be going the other way to represent. Some of it could be substantive analytical procedures. Okay, and that could constitute my body of substantive testing for some or all of the assertions embedded in the accounts receivable account. So, and of course, the related account sales. So that's what we're going to be talking about here, is how we'll look at some accounts, some analytical procedures to help with accounts receivable. We'll look at test of details, and frankly, the test of details is going to end up being confirmation. Confirmation is the best way to do a test of details on my accounts receivable. And guys, forgive me, I'm going to have to get my clicker. I don't know why I haven't put this thing away. So I always end up needing it, but I put it away. You see what happens when you are trying to be neat. Okay, so let's take a look at substantive analytical procedures. And the key thing that we're going to be doing with these analytical procedures is getting a feeling, quite frankly, for the valuation assertion. Okay, the nature of these procedures, quite specifically, is the valuation assertion that we can use substantive analytical procedures for. And you can see the nature of some of these. For example, accounts receivable turnover, okay? Days outstanding in accounts receivable. So essentially, to do our accounts receivable turnover, we'll go ahead and take our net sales, divide that by the average receivable for the period. That gives us our accounts receivable turnover. And then you go ahead and divide that turnover by 365 days. And that'll tell you how long your receivables stay in receivable status. How long does it take to collect? Well, obviously, and of course it varies by industry, but you know, for accounts receivable, frankly, I say it varies by industry, but not as much as some other accounts might. But for accounts receivable, we're talking what, 30, maybe 60 days. Generally, an entity is not going to be much longer in collection status in their receivables if it plan to have any sort of proper cash management. So I would say 30 days is probably a reasonable period of time. You start to get outside that 30 days, and then you start wondering about the ability of that entity to collect. Now, different objective, I was on an engagement where we were looking at how the federal government was doing in collecting fines and penalties. And so we did basically days and receivable status analysis of various federal agencies, and then we picked the ones that were taking, inordinate amount of time to collect their fines and penalties. And one of them that we looked at was the Office of Surface Mining, was taking months and months to collect the receivable, and their receivables were outstanding in 1-2 year time frames. And we looked at that and said, well, what's going on there? It shouldn't take them that long to collect the receivables. And what they told us was, well, what happens is when someone pollutes the environment, taking coal out of the ground, Office of Surface Mining make sure that they clean up their mess after they take all the coal out of the ground, that they sit there and they find these entities that don't clean up. And then if they don't collect, they run the person out of the business. But what we found out was there was some regulatory or some statutory requirements in the law that didn't allow them to keep companies out. The company could just reform as another corporation. And so we advised, we recommended some change in the laws that would make it a little easier for entities to, for the Office of Surface Mining to collect on those fines and penalties and have a little more teeth in their enforcement actions. Different objective, but by the same token, trying to get a sense as to the collectability of the receivables, the valuation of the receivable, right? We have accounts receivable minus, okay, say my account receivable is 100,000 less the allowance. Okay, say the allowance is, I don't know, I'll just make up a number, 2,000. Then the net account receivable would be 98,000, right? Okay, and so you'd want to see, well, how long are these staying in receivable status? It starts to get, and again, there's no like law that says, hey, it's got to be 30 days, and standards won't say 30 days. I'm just saying the experience would be, hey, if they start getting outside of 30 days, then how collectible are they? Okay, so that would be sort of a high level, but you could also do an aging by category. So you literally will say, and we're going to look at a slide here in a minute, but I think you've seen those. What's the total amount of the receivable balance that's 30 days, with this current, 30 days past due, 60 days past due, 90 days past due, etc. And that aging schedule will help to determine what should go into this allowance. So the longer they are in receivable status, the more that should be going into the allowance. Okay. You could also look at that debt expense as a % of revenue, and you may do a longitudinal analysis there, saying, well, what has it historically been? Seeing, is it growing? Is it staying about the same? Is it fairly stable year to year? Are you having large increases? Are there problems with the economy, right? Maybe this year we might start to see some entities are putting more in the allowance, or a higher percentage of their sales are going to bad debts because of some of the problem with the shutdown of not of the government this time, but of the economy, etc. Okay, so you can see some of these various analysis that you can do. What's good, analytical procedures that you can do. What's good with these type of things, large customer account balances compared to last period, et cetera. What's good these days, again, using data analytics, you can probably do some fairly detailed analytics using data analytics to see what's happening with an entire population of receivables, that sort of thing. Okay. All right, good. Now, as I mentioned, we would look at this with the aging. Notice they figure out, which categories these fall in, and then, depending on how much falls into these various categories, then they could decide to put more. They put more in the allowance for those that are obviously 90 days past due, and probably lessen the allowance for those that are less than 30 days. Sometimes students will say, well, why would you put anything in the allowance for those? They're not past due yet. Well, the reality is every time you make a sale, unfortunately, there is a credit sale. There is a portion of that you won't collect. Sometimes students say, well, will the allowance ever be zero? And my answer is, yeah, if you only have cash sales. So you can get rid of accounts receivable, you can get rid of the allowance. As long as you've got accounts receivable, unfortunately, human nature, the reality is there's some portion of that you won't be able to collect. Okay. Now, this slide, they say the auditor's primary concern is whether all accounts receivable have been included in the accounts receivable balance, and they're saying completeness. I don't know. I'm not going to put a label on the auditor's primary concern, and this bothers me a little bit because they're sitting here and they're saying, well, your primary concern is completeness. Meanwhile, I'm kind of worried about existence of receivables, because what happens if they debit account receivable, they credited something, they credited sales most likely. And remember, we're worried about what? Overstatement of the sales account. So I'm not sure that I would agree with this, that the primary concern is the completeness assertion. However, I do agree that we would want to make sure that the receivable is complete. And they talk about reconciling the age trial balance to the general ledger account to detect an omission of a receivable from either the subsidiary ledger or the general ledger. And I agree that that would be a good procedure. But the one that I would want to do is to look at some cash collections that happened and see that indeed those cash collections were listed as a receivable prior to their collection. Okay, that would probably be a good completeness test as well, because if it was listed as a receivable, then if they collected money on it, then it should have been listed as a receivable. So that would probably be a good completeness test as well. Valuation is really going to be about the allowance. Okay, we've really talked already about some analytical procedures you can do over the allowance, and we talked about potentially using that aging of account receivable. And essentially what the auditor will do here is recalculate. Okay, so you'll look at that aging, and you'll look to see that you're satisfied based on industry analysis or historical collection rates for that company. You can go ahead and see if you're satisfied that they place enough in the allowance for those various different categories. And then we're going to be looking at confirmation here pretty quick. And for confirmation, we're going to be really primarily testing the existence assertion. But by the same token, you could get some sense of valuation, and that if a client's customer is coming back and saying, well, look, I'm not going to be able to pay on this receivable, or they're giving you some different additional information, that could help a little bit with valuation. But for valuation, the best thing is that aging, the best thing are those analytical procedures, and really doing confirmation of account receivable is the primary procedure for accounts receivable, and it is the existence assertion that helps you with. So let's go ahead and take a look at that existence assertion. Also, it does help you with rights, because if the client's customer is coming back and saying, yes, I do owe on this account receivable, that means that the entity has the right to collect that. Okay, if they come back and say, well, no, because this is pledged to somebody else, then maybe the rights are not necessarily associated with that. You might find that out through confirmation. So confirmation is the best source for testing the existence assertion. Now with confirmation, what do? We will go and we'll probably use one of these data analytic tools using our audit sampling, where we'll go and remember we could stratify, take off some big receivables, but then we might use a data analytics software like IDEA or something like that to pull a sample of accounts receivable that we will put in the parameters of what it is that we're wanting. Our, what is our tolerable misstatement? What is our expected misstatement? Our sample size? I mean, our population size, I should say. All of those different factors will determine the sample size, and maybe we'll even use dollar unit sampling to pull those account receivable balances. Remember, we had that example when we went through chapter 9. So we'll go through and we'll have an account sample of account receivables that will be pulled by the software, and we'll send those letters out. And when we send those out, they are controlled by the auditor. So the auditor, even though on the letterhead, it'll be the client's name, because they're not going to recognize the audit firm. They're going to recognize the client name, et cetera. But when that confirmation comes back, it comes back directly to the auditor. So we have what? We have external evidence. We're pulling the account receivable balance for the various customers that are in our sample from the client's subsidiary ledgers, sending those out and getting that information directly back. That is the best way to test the existence assertion. In fact, the standards actually call out confirmation as a required procedure. However, we're going to see that if you can't do confirmation, they will let you do something else, but you really should do confirmation in most cases. Okay. All right. So when we look at confirmation, notice we say that it is a good source of information about the existence assertion. And as I've said, the auditor is going to control those confirmations. Okay. You'll pull the sample, you'll send the letters, you'll receive the letters back, even though the letterhead will, maybe you could use the client's letterhead, but it needs to come back to you. You need to control it. The other thing, because these days with a lot of things being done electronically, you could send electronic confirmation, but that needs to be cooperated with some sort of physical confirmation as well. So sometimes it's a little quicker to get the answer via email or something, but you may ask that they also send back a physical copy as well, so that you have that to support what they are saying on the confirmation. Okay. Now there is an opportunity to do something other than confirmation. Okay, so sometimes you might be in a situation where the client asks you not to confirm the account receivable. Would you be able to do that? Okay, well, the account receivable balance is immaterial, whatever. I always find it annoying when they say if something's immaterial. If something's immaterial, you're not going to audit it, period. If it's immaterial, who cares? You don't audit immaterial things, okay? If it doesn't have any possibility of making any difference in the decision-making of the user to the financial statements, then you just don't audit it, okay? So if external confirmation would be ineffective, if your risk of material misstatement is low, then you could possibly not do confirmation of account receivable. Now, you could have a situation where your client asks you not to confirm the account receivable. Okay, so let's say your client says to you, you know, last year you did confirmation and it took us weeks to get our customers comfortable that we weren't in some kind of trouble, weren't going bankrupt or something. Is there an alternative procedure? Okay, is there an alternative procedure that you could perform and not confirm the account receivable? So I'm pitching that question to you guys. Okay, let's say you have a client that says, we really would prefer you not to do this confirmation process. Can you do something else? Is there an alternative procedure if confirmation is not possible? Now, the way to think through this, guys, is confirmation is really testing what? The existence assertion. So we're going to have something that helps us look at the account receivable subsidiary ledger and get some information that helps us to be satisfied that that receivable actually existed at the balance.
Would you be able to see like shipping documents that you sent the client, whatever product you were shipping?
Okay, so we'll look at that receivable balance and we'll go out from that receivable balance and we'll see that there's a shipping document that supports. A little bit hard to do it for the entire balance. So I reckon in a situation like that, you might select a relatively large debit to the receivable for that client and see that there was some sort of evidence that those goods were actually shipped, right? Because if I have an account receivable, say for Smith, and there's a balance in there of 10 million, right? What you're talking about doing, if you know there were 10 million $1 purchases, looking for shipping documents for every one of those $1.
Oh, I see what you're saying. Instead of a single invoice.
Well, no, but hang on. If it's just one $10 million one, right? That was the only sale to that customer, then yeah. And if that's a fairly large percentage of the account receivable balance, I think you got something there, right? So it really would depend on the, you know, the overall account receivable. Smith is their biggest customer and it was all off of one sale, then, you know, that would be a pretty good thing that they ship those goods, right? Okay. So yeah, you could do that. How about something that might, let's say we didn't have this. Let's say we wanted to use a sampling technique of some sort. So instead of looking for, you know, kind of an outlier like this, is there a sampling technique we could use that doesn't involve confirmation? You know, because if we look and we're like, okay, you know, we can't see that one golden egg in there that we can, you know, that we can audit that one transaction. And, you know, wouldn't it be wonderful if, you know, we could audit just one transaction and get all the evidence we need to support an assertion? That's probably the exception more than the rule, right? So it's a series of transactions that really make up the account receivable balance. We can't really do a nice, beautiful stratification like this.
The sales journal. Review the sales journal.
Okay, well, again, the sales journal is simply going to give us the credit side to the debit, and if something's included in the sales journal, then if you want to audit something in the sales journal, I think then you're going and you're going to get shipping documents and that kind of stuff. Okay, but again, that's not going to help me with this accounts receivable balance necessarily. The total balance that they're showing, that might help me with a few transactions. But what's nice about sending out confirmation is I ask them about that entire balance, right? So I'm getting evidence for that entire balance. But what if I can't do the confirmation?
I have a suggestion. For example, because I work in a bank, maybe if as a bank you want to audit, for example, the sales, for example, if it's like a loan, it's like a mortgage, you want to see if these sales on like these mortgage sales are right, you can go to the title report and see like are the city or the bank on that title or not. So you don't have to even call the customer or the clients, because you can see on their title that the bank has the lien, for example. So you don't need to confirm it with the customer at all.
Okay. Well, I don't know. I'm not as familiar with specific on how to audit, banks and mortgages, so I don't want to get into, I'm not looking quite that granular. I mean, I suppose if the bank is the one that is actually holding the loan, that might work, but most banks take those loans and bundle them into mortgage-backed securities, and they sell them to Freddie Mae, Fannie Mac, or Freddie Mac and Fannie Mae. They send those and they sell them, and then all they do is service the loan. So they don't really have a receivable because they've already sold that loan, and then they simply sit there and service it. In the rare case where the bank actually holds the loan, I suppose you could audit the rights assertion there, and could look to see that their bank is on title, I guess. Generally that's done in a specific to a bank audit or something. But let me just stop the mind reading thing that I'm asking you to do here. And I don't know if it's mind reading, I'm just trying to get you to think through. If I'm listing at 12/31 that, I don't know why I'm writing Smith again, but let me write Smith again. That Smith owes me $5,000, debit on the left. Okay, now I could say, okay, I'm going to send out a confirmation to Smith to say, hey, at 12/31, did you owe 5,000? But I don't want to send the confirmation. What should happen if Smith owes this company $5,000? What should happen? Okay, let me put it in your own terms. If you loan me $5,000, what do you expect me to do?
Pay it.
You expect me to pay you back, don't you?
Yes, you invoice the person, but I don't see how that's really helpful.
I've already invoiced them.
Oh,
If I owe you $5,000, maybe this sale happened 11/30. I've already invoiced them. They got the goods. I've invoiced them, and they owe me $5,000. What should happen here?
well, they should pay it, but if it's an AR, then they haven't paid it yet.
Will they ever pay it?
Hopefully.
Okay, well, when would they pay it, do you think?
Well, if it's 12/31, then hopefully before the end of January.
Okay, good. So why don't I go to the cash receipts
Oh,
in January,
smart.
okay, and see, oh, there's a cash receipt of 5,000. Okay, so they really did collect on that receivable, didn't they?
Yeah, okay, that makes sense.
So I'm going to look, and since that's being included in the accounts receivable balance at 12/31, then good evidence, excellent evidence that they actually had that receivable actually existed, is the fact that sometime in that next year in January, there was a debit to cash, a credit to account receivable, right?
Okay, that makes sense.
Okay, so that's what I'm talking about there. That could be an alternative procedure. And then earlier, what I was talking about for the completeness assertion, you might look at January, February cash receipts, right? And you might match those up to outstanding accounts receivable balances, right? Because there should be something in the cash receipts journal that says, well, that was for, I'm going to stop picking on Smith now. I'm going to make it Jones here. That was for Jones, and somewhere in there should have been there should have been for the account for Jones in the subsidiary ledger, there should have been a receivable of 3,000, right? Okay, if they collected, well, then that should have been shown as a receivable. So now you're going the other way for completeness, right? For existence, you go from the financial statement to the supporting documents, and the supporting documents still happen to be receipts in the next year. For completeness, you're going to go the other way, right? Okay. All right. So I'm just giving you some ideas of things that you can do outside of confirmation if you find yourself in an environment where confirmation may not be possible. The probably biggest time that confirmation won't be possible is if you're auditing well after the balance sheet date. So someone has asked you to come in and do the auditing after the balance sheet date. It can get a little bit difficult to go back to your client's customer and say, well, what did you owe 6 months ago? Your client's customer may say, I don't know, our accounting system isn't geared up to answer questions about things that happened 6 months ago. We can tell you what we owe now. It's difficult for us in our system to go back and look at dates that are that far back. You might do some sort of subsequent receipts review like we're talking about here. Okay, question, guys? Okay, good. Let's go ahead then and let's take a look at the couple different types of confirmation. There's positive confirmation and there's negative confirmation. Positive confirmation means that you expect to hear back from your client's customer. So you ask them, please respond, okay? Now, when we deal with positive, we could have blank positive. Okay, so there's positive and there's blank positive. Positive is say, do you owe? And you tell them the amount, 25,000, and you literally, let them say yes or no. Okay, and you might ask them if no, how much do you think you owe? But if they say, yeah, we owe 25,000, they'll check yes, you've got positive confirmation, you expect to hear from them, they did, they send that back to you, you see the yes check. Blank says, how much do you owe? Which one's better? Which one gives you more reliable evidence? Now you make them fill it in. Which one gives you more reliable evidence?
The blank.
Good, blank positive, because now they have to do homework, don't they? They got to go research it and figure out what the right balance is. So you're getting better evidence. The only problem with blank positive, do you like homework, Andy?
No.
Yeah, you can be honest. Nobody likes homework. And you just gave your client's customer, homework assignment. You just told them, go figure it out, right? So there's a chance that, you're going to have to hound them a little bit more for this better evidence, right? So what's happening? We're sitting here and we're trying to choose between which one. So when would you use positive? When would you use blank positive?
Would you use blank positive if you have some other evidence that it may not be the correct balance, or it may not be the correct balance, and then you'd use positive if you think it would, but you still need the evidence?
Okay, you're right there. Speak to me in audit speak.
Oh boy.
Take this to me in the terms that we've learned in chapter 6, which you just told me.
Yes, I know. If you found the internal controls to be effective, then you would use positive. And if you found them to be ineffective, then you would use the blank positive.
Good. Okay, good. So that's not quite what you said the first time. The first time you said to me, hey, my inherent risk is coming up. The second time you said to me, the control risk is coming up. So my risk material in the statement is high. I'm going to have to lower my detection risk, nature, extent, timing, nature. Now I'm looking for the most effective audit procedure, which is what? I'm getting external evidence. I'm going blank positive. I'm making them fill it in, right? If my risk material misstatement is not quite as high, then maybe I'm okay with just straight up positive where I tell them the amount and I want them to check it off, right? Good. Excellent. Excellent. I don't know who was talking. Who was that?
Davi.
Okay, thank you, Davi. I didn't recognize your voice that time. Okay, so when would you use negative? Well, negative, did I say this already? I think I did, but let me repeat it. Negative is, I don't care. Only respond. If you say in the confirmation, only respond to me if you don't agree. So you send something to somebody and you say, only respond to me if you don't agree. Okay. You know, for example, I made a mistake when I was in the 2nd grade. I had my friend give this somebody that I liked. I said, hey, get my friend. I said, hey, give her this letter. Do you like me? Yes or no? Okay. And she checked no. Okay. So that was how I got the answer. Okay. What I should have done is I should have said, I only want to hear from if you disagree. So you can somewhere in your mind, pretend like you got the right answer, but you got the yes answer. I'm not sure how that relates. Note to self, don't use that example anymore. Okay, but when would you use negative? Where you don't necessarily expect them to respond to you. Well, what's better, evidence, negative or positive?
Positive.
Positive, because you hear back, because negative, they may just go, okay. So we're going to throw this thing away, right? Right? So they say don't only respond if you don't agree. Just get this out of my face, right? I'm just going to throw it in the garbage, right? So when would you use negative?
Would that be the same situation? You think the control is already good, then you
Material misstatement must be really coming down, right? I must have good internal controls and probably a fairly low inherent risk, right? Okay. So for example, if you're auditing PG&E, go ahead, try to come up with a representative sample of positive confirmations. You'll be there for the rest of your life trying to sit there and say, do you owe, $111 in your PG&E bill, right? What you would do if you're auditing PG&E, since they probably have good internal controls over their receivable, maybe not over their gas lines, but they probably have good internal control where their power lines are going to knock down some trees. Apparently, they're, start a fire. Apparently, their controls aren't too good there, but they probably have pretty good controls over what they're owed. And so you'd say, okay, I have a low risk of material misstatement here. I have a lot of fairly small dollar amounts, right? They've got millions and millions of customers. And so you would send out negative confirmation if you're auditing an entity like that. You say only respond if you don't agree. Okay, question? Okay, good guys, good discussion. All right, so let's go ahead and let's take a look. Which is basically what I just said. Probably should have been on this slide while I was saying all that. Positive, and negative, and then positive could be what? Could be just straight up positive in which you indicate the amount, or you could have blank positive. Okay, again, you could do these confirmation at interim. And it would be helpful if you could do it at interim, but again, it depends on whether you have a higher risk of material misstatement or not. If you aren't able to do it at interim, then you would do it at year end. If you do it at interim, then say the year end is 12/31, and say you're sending out the confirmations at say 9/30, then you would have to do some roll forward work to satisfy yourself that the account balance is fairly stated. At 12/31, you probably use some sort of analytical procedure. Okay. Okay, I think this is stuff we've already talked about. Oh, here you go. Here's the alternative procedures. I jumped the gun a little bit. This is some of the things you guys talked about. Okay. This is the best one though, in my opinion. Subsequent cashed receipts. If I couldn't send out confirmation, I'd be all over this. And I have no idea why they put that as blinking eyes down there. I don't see how that's relevant. Okay. All right. We've talked about this, how we would consider the sampling and how we might use the results of the findings to determine if we have a material misstatement. This really should be in chapter 8. Okay, any questions about any of that? Or chapter 9, I guess, is where we're talking about that. Any questions about any of that? Okay, good guys. So I'm gonna take, we're gonna take a quick break, okay? And then we will continue on with chapter on cash disbursements, which is going to be chapter 11, 12, and 13, okay? So why don't we go ahead and take about 10 minutes and we'll come back. Okay, guys, we're gonna go ahead and jump in. And is there a question?
It's me. I sent you a private question.
Oh, okay. Yeah, sure. We have time after. I think we're gonna
Okay.
get a little quicker today. So yeah, we should have time. Not a problem.
Okay, thank you.
Yeah. So let's go ahead and let's take a look at chapters 11, 12, and 13. And I know, guys, it's a little daunting. Holy Toledo, we're going to be here for hours talking about 3 chapters worth of information. But when you really look at this, these 3 chapters, they're really talking about cash disbursements, and they're talking about them generally in purchases. We can purchase services, of course, but we could also purchase goods such as equipment. But really, when we think about purchases, we're primarily talking about inventory. So I think it's okay to talk about purchases and inventory together. And of course, cash disbursements come up in the context of payroll. And now, guys, I forget now if maybe it's chapter 13 is inventory and 12 is payroll. Don't hold me to that, something like that. But these 3 chapters cover these areas. Okay, so we're going to look at them all together, and we're going to see that it's not a whole heck of a lot of stuff that we're having to look at. So let's just take a look at purchases. Okay, and we start with the purchase requisition. Okay, and with the purchase requisition, the department in need of the assets, services sends a properly approved purchase requisition to the purchasing department. Okay, now they tell us that the department that is essentially ordering the goods, the requisitioning department, should not actually be allowed to place the order. They say that would be a weakness in the internal control. Why? Why do we have two separate departments? We have the requisition department. We've got our IT department. It says we need 25 laptops. And so we don't want our IT department manager to call the computer vendor themselves or place the order with the computer vendor themselves. We send it to a separate purchasing department. Why?
Segregation duties and getting proper authorization.
Good, you both kind of said the same thing in different words at the same time. Separation of duties. This purchase requisition is an authorization, isn't it? Remember, we want to separate what? Authorization, record keeping, and custody. And as we go through and we talk about these various departments, I'm going to keep balling back to you, hey, is this authorization, record keeping, or custody? Okay, so what if we're talking about a separation of duties and internal control, when we're talking about this being an authorization function in achieving the separation of duties, what's the potential misstatement? What could go wrong? What could be the problem here that this separation of duty, internal control, by separating this authorization process from the authorization, frankly, to place the order, because they're both authorization. Okay. I mean, placing the order is also an authorization, but why do we have to separate this placing the order? What could go wrong if we let the same person who is ordering the computers also is the one that goes out and buys the computers, orders the computers?
Misappropriation of assets. Could they could just order them and take them home? No one is watching whether they're using them for, I don't know.
Well, we're going to have a custody of the asset. When the goods are received, they'll come into a separate shipping department, and then those will all presumably in that shipping department be counted and logged in as having been received. And so there'll be a separate custody, so they can't just take them home. And then periodically, with equipment that's being used in the company, there should be some sort of periodic reconciliation between what we've issued to employees. Hey, do you still have that, right? When I retired from the government, I remember they made a big deal about me turning in my computer. Meanwhile, I looked at the computer, I'm like, this piece of junk's worth all of, $300, but okay, yeah, make sure and turn it in. But they were obviously tracking it. We've had the same computer for years. I was like, okay, why would I even think of, well, I don't want this piece of junk? But they had obviously kept track of, hey, this is the barcode that we issued to John Lord, blah, blah. And they wanted to make sure that I turned it back in. Okay, so there are ways to control, if someone's stuff comes in, it gets logged in, it gets a serial number, probably gets a tag put on it. And then when you issue that to a particular employee, then you can continue to track that. But there's something else. Okay, we generally have a separate purchasing department to make sure that we're getting the best price. So now what happens? I didn't want to strike that out. I wanted to highlight that. Now what happens? Now we're sitting here and we're getting this best price. We have a purchasing department whose entire job is evaluated on, are they getting us the right best prices, right? That's their whole function in the companies, to get the best price. And this avoids a situation where if a computer vendor knows that I run the IT department, they know that I'm responsible for committing the entity for all their IT needs, they start doing things like sending me tickets to the ball game and spending me on expensive vacations and that kind of thing. Hey, we want to make sure that we keep chummy with you. And what happens? Now, all of a sudden, I'm not being as vigilant, not being as careful about getting that best price because I like this vendor because they are really nice to me, right? They give me all this stuff. They may even give me a kickback. Hey, you know, we're going to charge the company $10,000 for this order, but you're going to get yourself a couple thousand and we'll give you a couple tickets to, you know, Hawaii or something. And this has happened, guys. I'm not just making this stuff. There's lots of cases like this. So the way you avoid this kind of thing, right, is to separate the requisitioning department, the department that is basically tasked with committing the entity for the various needs, versus the actual ordering of the goods goes to a separate department, this purchasing department. Okay. Now, when the purchasing department prepares the purchase order, it's actually a 4-copy purchase order. Okay, so what happens? There'll be a pre-numbered purchase order, and there will be 4 copies, and you can kind of see in the little graphic over here what's listed here, and that one goes to the vendor, obviously, or how we're going to get the stuff. Hello. One goes to the requisitioning department so they know, hey, we have placed your order. One will go to the shipping department, okay? And so now they're waiting for those goods to come in. And one goes to the accounting department because the accounting department needs to know that at some point they're going to have to set up an accounts payable for that. So the accounts payable department, okay? So you have this 4-copy purchase order. Now, what happens? It is preferable that the copy of the purchase order that does not, that goes to the receiving department does not list the quantity. And we say here, therefore, the company has to, I should say the receiving department has to count the goods. Okay. But can you think of another, not just to, you know, force them to be diligent about counting it, to fill in what would be a problem if you actually put the number in there? You said, okay, 25 laptops. What might happen? Let's say we know they're going to count it. Let's say God comes down and says, I am going to make sure that the people in the receiving department count the goods. Don't worry about that. I promise you, I will force them to do it against their will, that they will count the goods. They'll be like robots counting the goods. Okay. Would you still want to make sure that that amount is blank? The quantity ordered is blank on the receiving department's version of the purchase order.
Yes, because if 26 were delivered and they see that there should only be 25, someone could pocket one.
Ah, I didn't know that there was other people from Hayward on this call, on this Zoom meeting. Okay, right, exactly what happens. If there's 26 and the thing says 25, guess where number 26 going? Number 26 is going in the trunk of their car or something after they pushed it off the back of the receiving dock. And then when someone questions them, well, wait a minute, the company says that they sent us 26, you checked off 25. The person can say, well, there was only supposed to be 25. I counted 25, right? So good. So you would want them to actually count that, right? Okay, excellent. Okay, so again, internal controls, separation of duty, authorization, right, for the requisition, authorization for filling out the purchase order, for copies, and then we have the separation of custody of the actual items in the receiving department, and they're going to have to get a good count on those goods. Okay, then what happens? Then the copy of the purchase order sent to the accounting department will let them know that, hey, you've got a disbursement coming up. Okay, now the invoice arrives. Okay, and the accounting department, if we're in the accounting department now, what function is this? Authorization, record keeping, or custody?
Record keeping?
Yeah, this is record keeping. Figured you'd all be fighting to answer that one. Okay, good. That is record keeping. Okay, and so now what? Now the accounting department approves the invoice by matching it to the purchase order, the receiving report. They may even get the requisition, not necessary. Okay, and so now they are going to go ahead and process that for payment. They process that for payment, but should the accounting department have the ability to actually disperse the cash?
No, because it needs to be separated.
Good. Now we need a separate what? A separate custody authorization of the cash, right? Okay, custody / authorization to pay. Okay, now they come down here and we say that there'll be an approved purchase order. Okay, that approved purchase order that they talked about up here, that approved, I shouldn't say purchase order, but that approved invoice now is going to come down, and it's going to include the match invoices, the purchase order, the receiving report, the requisition that the accounting department prepared and sent down, and it is received by the treasurer. Okay, and the treasurer is the one that is authorized to go ahead and sign and mail the check, cancel all supporting documents, and then the treasurer will do what? The treasurer is the one that will turn around and send that back to the accounting department. Okay, when it goes back to the accounting department, now I'm just going to go back up. The accounting department, who has the record keeping function, will go ahead and debit the payable, credit the cash, so that we have a separate accounting. Okay, so you can see that we've separated the duties, right? We have the authorization to order, the authorization to request the goods, the authorization to order. We had the what? The custody and the shipping department, and then we did our record keeping up in the accounting department. The actual disbursement of the cash happens by the treasury department. They're the ones that are actually going to be able to disperse that. They mark everything as paid, and then that goes back to the accounting department to reverse the payable, debit the account payable, credit the cash, or record keeping function. Good. Now, you look at this and they say invoices should be paid by check, blah, blah. Do you write checks? Anybody write checks?
I had to for our CPA exam for the first time in 5 years.
Right? Why are they on snail mail still? That's a good point. Shouldn't that be by credit card? Okay, very irritating. Yeah. Okay, so for what? One-offs like that, right, Jennifer, to register for the exam, you had to write a check. But most of the time you use online banking, I'm assuming, like when you have to make a payment, you do it online banking. Well, most companies these days are going to be using some form of online banking or electronic funds transfer, something like this. So doing this process and looking at all these checks and whatnot, seeing that things are stamped and whatnot, even though you often get asked that way in an auditing class, is this the process? How might you do this in today's environment where most of these things are done electronically? Let me tell you. Oh, go ahead.
Oh, I'm writing a check and we do it remotely. So basically, I will send the a payable list to my owner. For example, company A pay $1,000, company B pay $2,000 with the attachment for whole invoices and supporting documents, and then I will repair the transaction. And then most of the bank right now, they have dual authorization. So if I create a transaction, he needs to approve. I cannot approve under my account. So that's what we do it.
Yeah, exactly. And as an auditor, I would come in and I would say, please let me see the rights that various individuals have in this system, right? And my expectation would be that a payment can't be, you can't both release and authorize the payment, right? There should be somebody else who authorizes the payment and then someone else who's able to release that payment and make the record keeping, right? Or they can release the payment, they can authorize and release the payment, but they can't affect the change in accounting records. That would be done up in the accounting department. And an auditor could ask for some sort of, computer, printout or information that'll list the different rights that different individuals have in the system, right? So there's a way to check that, right? So that would be an example of auditing through the computer, because you can't always get all of these hard documents and whatnot to look at in today's environment. Good. Okay, good. So let's go ahead then and take a look at the next slide. If I can see where my clicker is, okay. And this is a, pretty, okay, color document here and everything, okay. But what I want to do is I want to see if we go through this, and we've already talked about it, but let's just review. And guys, when you look at these flow charts, and auditors are all about flow charts, and I've seen auditing classes taught where, they'll make you fill something like this in. Okay, I think that's a little overkill. Okay, but what I want to make sure that if I asked you which is the duty, the separate duty that should be performed by these different functions, what would be your answer? So it'll be either authorization, record keeping, or custody. Okay, so purchasing is authorization. The receiving department was what? Custody. Remember, it's a 4-copy. The accounts payable department was doing some record keeping, and the treasurer, and I'm going to go ahead and put an A and a C there, okay, because they are able to authorize the payment. So in effect, they have custody of the actual cash. Okay, so just to sort of summarize what we put, you can glance at that on your own, not a big deal here. Okay, good. So we looked at our various internal controls, and now we're going to go ahead and start to look at our substantive procedures. And notice we're going to line up our substantive procedures with the assertions. Why do you think I'm starting with completeness?
Is it because you move backwards and you'll hit different parts of the process that will give you evidence for other assertions?
Well, we're working on the completeness assertion. Let me just say, rather than ask the question, well, let me ask it this way. Well, let me just tell you, stop. Completeness is the assertion that we're worried about for liabilities. Right? That's our primary assertion that we worry about for liabilities. For accounts receivable, we were all over the existence assertion, because if they're listing an asset, we want to make sure they haven't put an asset down that doesn't exist. For liabilities, our concern is what? There's something that they should be paying, they're liable for, they're obligated to pay, and they've left it off of the balance sheet. So they're going to be doing what? Overstating the value of the company. They're going to be understating, if they leave off liabilities, they'll be understating their expenses, so their net income will look larger. So there's a higher percentage chance that somebody's going to make an investment in a company, overpay for some sort of investment, stock, a loan, or something like that, and then they're going to come after the auditors for missing the completeness assertion. So auditors worry more about completeness assertion. We'll also talk about existence assertion, but we worry more about completeness assertion because that's affecting the CPA's business risk more than the existence assertion would for liabilities. For assets, our CPA business risk is more more vulnerable to what? To the existence assertion. Okay, so we're starting here, and we do some sort of boring steps that we list up there, but I want to look at this what? Search for unrecorded receivable, payables for unrecorded liabilities, and we're doing that under the completeness assertion, and we'll select cash disbursements that are made at subsequent to year end, and then we'll go back from those disbursements to see if those were listed as a liability. Okay, so let me see if they'll let me draw down here. So what happens? Change the color on that. I still don't understand why Microsoft can't figure out how in PowerPoint to have a nice little color palette, you know, a little palette right here, like they do for Word. They have it for Excel, where there's a little set of pens that come up, but they don't do it for PowerPoint, which to me is the one that you're probably going to be marking up more than any of them. But I don't quite understand why they don't have it that way. But I guess I'm not. That's why I'm not a billionaire. What's his name? I'm not Bill Gates. Okay, so what happens? I have accounts payable, and I have accounts payable at 2020, 12/31, we'll say. Just read that. Okay, and they have account payable 1 that's showing for 100,000, and they have account payable 2 that's showing for 50,000, and account payable 3 for 40,000. I'm just going to keep running them over here. Account payable 5, and that's for 70,000. I don't know, guys, I'm just making these numbers up. Okay, so what happens? They have these account payable. Maybe they have a bunch of other ones. Okay, but I'm sitting here and I want to make sure that this account payable balance is correctly stated. So let's say the total is $1 million. Okay, so is there some way that I can make sure, because this is scary for the auditor, what if they didn't list an account payable here? Maybe there's an account payable that they didn't list, right? So I want to try to find one that isn't listed here that should be. So what do? Well, I look at the January, February 2021 cash disbursements. Okay, that says cash disbursements. Okay, and I'll have cash disbursement 1 for 100,000, cash disbursement 3 for 40,000, cash disbursement, what is it? 5. Cash disbursement, be nice if I could count on, that would be cash disbursement for account payable for cash disbursement for 70,000. And then I have cash disbursement, I don't know, 5 over here for 10 million. Really? Okay, that says 10 million, guys. Okay, that cash disbursement 5 for 10 million. Now, what do? I go ahead and I start over here. So I take that first disbursement and I see, okay, was it listed as a payable? Yes, it was. The second one, yes, it was. So on, and I go through and I find these first 5, no problem. Okay, And then I go and I pull this one, and I would probably use some sampling here, but I go and I pull this one, this cash disbursement number 5 for 10 million, and I try to find it in the account payable journal at 12/31/20. Is it there? It's not there. So I say, well, what was this 10 million for? And that's when the client says, oh, thank you, auditor. Thank you for finding that. You're right. We should have recorded that as a payable. We had some problem. We had an employee that didn't understand procedures. They made a mistake, and that's why that didn't get recorded. Now, what's your reaction to that if the client tells you that?
Professional skepticism.
Yeah, excellent. Your professional skepticism starts to kick in because you're like, okay, well, if they didn't record that liability, they understated liabilities, they understated expenses potentially, and you're probably going to what? Ask some more questions about, well, what happened with this employee? What were the internal controls? What were the procedures? Maybe that's going to cause me to do what? Assess my risk and material misstatement higher now because I saw this error. And so what's that going to do? That's going to cause me to want to lower my detection risk more by maybe taking a larger sample size, or potentially, and I pull that larger sample size, and now maybe I'm finding a material misstatement, or maybe this error in itself will result in a material misstatement. I'll ask for an adjustment, or I may have to qualify my opinion, et cetera, right? Okay. Okay, good. Now, take a look here, and we also talk about examining open purchase orders, receiving reports, et cetera, right? And what we're talking about here is, well, look, why you ordered these goods in January? Why haven't you received them yet? Why haven't you opened up an accounts payable for this? Why haven't you received these yet? You've ordered the stuff. Now, maybe it's a legitimate answer. Maybe it's some sort of specialized equipment that takes a while to produce or something, and you're still waiting for that. The company's still waiting for that. Fine. But often by doing this, you find that, oh, it's not opened anymore. They actually did receive the goods. They should have both the receipt of the goods and also set up the payable for that. Okay, so these are probably the two best steps for completeness. And again, remember, it's taking information and coming back to the financial statements to look at the completeness assertion. Okay, now accounts payable confirmation is generally something that is not required by the standards. Why is it not required? You say, well, wait a minute, you said account receivable confirmation is required. Yeah, because we're worried about the existence assertion. They don't require it as much for accounts payable because accounts payable we're more worried about the, we're more worried about the completeness assertion, and confirmation doesn't help you with the completeness assertion. Think about it. You're pulling what? Payables from the subsidiary ledger and saying, hey, are you out there? Do you exist? Does my client owe you this amount of money? Well, if you're just pulling things off of the accounts payable subsidiary ledger, there's a chance that it's the one that's not listed there is your problem. Okay, so they don't require you to do accounts payable confirmation, but they tell you that you could do that if you want to, and they tell you that you should generally use blank positive confirmation when you are doing the confirmation, if you choose to do that confirmation of accounts payable. So now you're sending out a confirmation, and it's coming from the auditor controls that, but the voice is coming from the client, from your client to their vendor saying, how much do I owe you? And it's blank, right? And you want them to write you back. Now, let's say somebody sent you a letter like that and said, how much do I owe you? What would your reaction be?
You're an idiot. You should already know.
Well, okay. But would you say, well, gee, this person thinks they owe me money. Would you just say, no, just put 0 down? It's okay. Or would you say, well, why would someone send me a letter saying how much do they owe me unless they really owed me some money, right? So you start looking back anytime you even talk to that person. Geez, did they borrow $5 from me for lunch that time? Any interactions you had, you're going to start to take a good look at, right? So what's going to happen? Your client's vendor is going to go through and they're going to examine the account balance, and now they're looking at their accounts receivable ledger, right? And they're looking to see, is there any time that this person owed me money, etc., to make sure that they put the correct number down here, because they don't want to understate that number, do they? Because they want to make sure, I'm just making this number up, that you know that they know that you owe them $20 million. So in effect, your client's vendor does a completeness test for you. They go and they check the heck out of their information with your client to make sure that they're catching every potential dime that is owed to them, because they don't want to put down a number that's too small. In other words, they are going to make sure they put down a complete number. Okay, so you can't just use confirmation for the completeness assertion, guys. Okay, that is not, if I was reviewing your work papers, if I was doing a peer review and all you did was confirm the accounts payable, I'd say, hey, you got to add some of these other procedures like the subsequent disbursement test that we talked about a minute ago, but you can get some evidence to help you with the completeness assertion through this accounts payable process, but it should be blank positive to help you to make sure that their client's vendor is doing a thorough job in looking for those. Okay. Okay, good. So let's take a look at this question, and my favorite part is to have you do the poll. And we don't have an E here, but that's okay. Oh, I got to launch the poll. Okay, so go ahead and take a look at this one. This is actually one of my favorite questions of all time. Okay, good. Most of you have gone ahead and made a selection here, and pretty good result here. Okay, most of us got it right. Okay, which the answer is A. Okay, and so you can see that you know, over half the class got it correct. But let's just take a look at this one. And I'm going to go ahead and close the results of that poll just so I can write on this question. So I could have probably still shared it, but most of us got us right. You saw you know what you picked and you saw the outcome there. Okay, but let's go ahead and let's take a look at this. Okay, auditors suspect that certain client employees are ordering merchandise for themselves over the internet without recording the purchase or receipt of the merchandise. Now, when we say without recording, really, it's not gonna let me write on it. Okay, here we go. When we say without recording, what assertion?
Completeness?
Excellent, very good. If we say without recording, that means they didn't record it. That means the accounting records are not complete. So that means we're going to have to what? Find some supporting documentation that we will be able to take back to the records to find that missing item, right? Now, the problem here is that all of these are supporting documents. So this question's a little bit tougher because all of these are supporting documents. So now we have to choose what? The best supporting document, right? The best supporting document. So what's going to happen? Is there any way that these employees that are stealing this stuff can keep this stuff without paying for it?
No, that's how they're stealing.
They can't keep it if it doesn't get paid for, right? At some point, the vendor's going to start saying, hey, where's my money? So there has to be what? A cash disbursement, doesn't there? I mean, the vendor's not going to play with this. The vendor's going to say, where's my money? So you start looking at that cash disbursements journal and you start seeing disbursements for which what? There's no record of a payable. There's no record of a item being received, nothing, right? It's not being recorded. You take this disbursement and say, well, you disperse this money, but we can't match it to anything. How come? And that's when people start ratting each other out, right? Oh, it was so-and-so's idea to do this whole thing. Okay, so the cash disbursement is the best evidence because you know the vendor's sitting there waiting for that disbursement. If they don't get that disbursement, they're going to start to complain. And so if you start with the disbursements and try and take it back, that's how you find the missing items. Okay, now that's the very theoretical way to answer this question, but there was more in this question that helped you to answer it than just this theoretical discussion of how you audit the completeness assertion. Okay, it says when the vendor invoice arrived, one employee approves the invoice for payment. After the invoices are paid, the employee destroys the invoice. Well, if the employee destroys the invoice, I guess there'll be no what? Invoices to look at. Okay. Destroys the invoice and the related voucher. So I guess there'll be no vouchers now, will there? And then they tell us they don't record the receipt. So there'll be no receiving report, but you can't get rid of the fact that you had to disperse some money to that vendor, so the disbursement will be there. Okay, and that's when you would start taking that disbursement back to the accounting records or trying to find it in the accounting record. If you don't see it ever listed as a payable or receipt of merchandise, and you uncover this fraud scheme. Okay, question? Okay, so that's kind of a hard question, but again, if you look at it from the standpoint of the assertions, it's the best way to answer that. Okay, good. Let's take a look at inventory. And again, I stuck inventory into the same chapter as purchases, or the same set of slides. It's a different chapter, but the same set of slides as purchases, because you can see that a lot of what we've talked about already in the purchasing cycle is covered in the inventory cycle. So we have what? Purchasing, that is an authorization. Receiving is custody. Warehousing is custody. Shipping is custody. I'm just putting the first letter of each duty that is separated. And it shouldn't surprise us that we have a lot of, this looks like my report card from high school. It shouldn't surprise us that we have a lot of custody in here since we're dealing with inventory items. Okay, now come over to the next slide here, and this is important. Okay, it's important that we know that they require, okay, the accounting standards require that we be on the premises at 12/31 so that we can observe the client taking the inventory. Okay, now the client has to take the inventory. The auditor observes the client taking the inventory to make sure that they are using the proper inventory taking technique. What is the proper inventory taking technique? Okay, so we're looking at what management's instructions are. We're watching to see that the client's employees, when they're taking that inventory, are following those instructions. What's the proper technique? For taking inventory. Okay, proper technique for taking inventory is sealing the floor wall to wall. Okay, let me explain what we're talking about here. I was on an audit of the Senate restaurant. The Senate has its own separate restaurant. Okay, so all the senators can go and eat their lunch at this particular restaurant, whatever. If they have different functions, they, have it at the Senate restaurant. Okay, and so I was on an assignment where we were doing the audit of the Senate restaurant, and they sent me back and some others who were getting experience for our license. Okay, for get your CPA, state of California. If you want a test license, you have to do certain audit procedures, and one of them is observing the inventory. So to get that particular experience signed off on, I got assigned to the Senate restaurant to observe them taking the inventory. Now, when you go, the federal government's fiscal year end is September 30th, and it's fairly warm still in Washington, D.C., and they hand you a parka when you go to observe the inventory. Like, what are you giving me this parka for? It's hot outside. We're giving you this parka because you're going to go with this inventory counting team, and you're going to count freezer number 437. So now you're sitting in this restaurant in this freezer, watching the staff take the inventory, and they're doing this. They're going, how many pork butts in here? And they go and they find the pork butts, and they list 23. How many chickens? They're using the inventory listing. How many chickens? And then they go and find the chickens. How many hot dogs? I don't know, whatever was in that freezer. And they go ahead and they go and they find them. What's wrong with taking inventory like that? Speak to me in assertion language. They're going from the list and they're going and finding the things. What assertion is getting harmed here?
Completeness. There might be something in there that's on the list.
Beautiful. There might be something in there, a box of filet mignon that is not on the list. And what? If they're doing it this way, they'll notice, hey, the auditor didn't notice that we didn't count the filet mignon. Those are going home, right? Okay. So what happens? I stop them and I say, guys, that's not the way you're supposed to do it. You're supposed to go what? Sealing the floor wall to wall. You find everything that's in the freezer. And if you have an item listed there, then you can put in the quantity. If something's not listed, pre-listed on the inventory count sheet, then you're gonna have to add it there to make sure we get a good, complete listing of the inventory items. Now, you'll go out and you'll do this observation. They'll call it a preliminary inventory. You'll do this observation. You'll see if they're following the directions. In that case, they weren't following the directions, and so they assemble the inventory count staff back together for the next day for the real inventory count and say, now remember, it's supposed to be done this way. Now you go back out with them, and now you're going to start to get good counts on the inventory. Good. You're also doing what? Inspecting the inventory for its condition, and then you're going to perform some test counts. So for the most part, the client counts the inventory, but the auditor will also, on a sample basis, go through and count a few things and put some inventory tags on what they counted there. Okay. Now, they tell us that an auditor that is not present to observe the inventory will have to perform alternative procedures. Okay, now what are we talking about here? Let's say a client hires you on 6/30. Red here. A client hires you on 6/30, 2020 to audit the 12/31, 2020 financial statements. Balance sheet date is 12/31, 2020. Okay. Are you able to observe the taking of the beginning inventory? What should be the beginning inventory for a year end of 12/31, 2020?
January 1, 2020?
Right, January 1, 2020 was when you should have observed the taking of the beginning inventory. Were you there to do that?
No,
You were not there to do that, so you have a problem, don't you? Because what happens, beginning inventory, you don't know for sure what that was. You could probably get some evidence to help you with purchases. Whatever that was. That would give you what, goods available for sale? Minus ending inventory. Can you observe the ending inventory? Can you observe the ending inventory?
yes,
Yeah, that's going to be taken at 12/31, 2020. So you'd be able to observe that. So you could get some satisfaction with the ending inventory. But now goods available for sale minus ending inventory gives you cost of goods sold. So you're probably going to have a problem with what? With the cost of goods sold. So in a situation like this, what's going to happen? You would probably be forced to disclaim an opinion, depending on materiality, guys. Or qualify, disclaim or qualify, depending on the materiality, disclaim or qualify, let me say, or qualify. Okay, you're probably gonna have to disclaim or qualify on what? On the income statement. Because what? Because cost of goods sold shows up on the income statement. The statement of cash flows, because cost of goods sold is going to affect net income. And when you're using the statement of cash flows in direct method, you have to report net income in the operating section. Even if you use the under the indirect method, even if you use the direct method, you still have to provide a reconciliation of net income to cash provided by operations. So you'll probably disclaim or qualify on the statement of cash flows. And statement of retained earnings is going to be a problem because there's that annoying net income number again that affects the statement of retained earnings. You could potentially give an unqualified on the balance sheet because you were there at 12/31 to see that inventory, right? Okay, so maybe you can give an unqualified on the balance sheet, but these other statements you might have to disclaim or qualify on. So they want you to be there. Okay, in a situation like this would probably be the outcome. Now, let's say instead of it being June, the way I've talked about here, let's say that they hire you on 2/1/2020. And it's to audit the 12/31/2020 statements. Okay, now under this situation, were you there to observe the beginning inventory?
no,
You still weren't there to observe the beginning inventory, so you're like, well, John, why are you bothering me with this again? Well, if it was just essentially 1 month had elapsed in 2020, you might propose to the client, okay, let's take the inventory today. We'll take the inventory at 2/1/2020. We'll get a comfort level with what the inventory is today. And then we could reasonably back through purchase records, sales records, or whatever to come up with what the beginning inventory should have been at 1/1 and see if that matches what the client has listed as the 1/1 inventory and get satisfied that we did an alternative procedure. Okay, that's what they're saying here, that the auditor can perform an alternative procedure in this kind of scenario. Now, the client may say, hang on a minute, we just counted the inventory 12/31/2019, auditor. Don't come over here and start telling us to count the inventory again. And so we would say to them, well, fine, but this is what? This is likely going to be the outcome then if we can't audit, observe you taking the inventory, we can't get audit comfort with beginning inventory, you're probably going to end up something like that, and the client can decide, what do you want to do? Do you want to get these disclaimers on your income statement, statement of cash flow statement, retained earnings, or do you want to work with us to get us the evidence we need so that we can get potentially an unqualified, unmodified opinion on all of these statements? Okay. Question? Okay, good. Now, if there's inventory that's held off-site, then you're going to have to get some comfort level with inventory that's held off-site. If it's in a public warehouse, you might be able to get some sort of confirmation from that public warehouse. If there's inventory that's in another state, you're going to have to call to your other office in that other state or a colleague in another state and say, hey, can you go observe that inventory? What happens if you have a client that has a warehouse in San Francisco and a warehouse in San Jose? And you are the only staff that's going to be available, your team's the only team that's going to be available to observe that inventory. Well, I shouldn't say your team's going to be the only team available. What if they say to you, okay, well, here's what we're going to do. We're going to count the inventory in San Jose on Monday and the inventory in San Francisco on Tuesday. Are you going to be okay with that? We got two warehouses, one in San Francisco, one in San Jose. They say, we'll count the inventory in San Jose on Monday and the inventory in San Francisco will count on Tuesday. What do you
No,
say?
I'm not okay with that because they know ahead of time. And is it better to not give them notice that you're going to be there observing them counting inventory?
No, you're not going to sneak in. You're
Okay.
going to be there. You're going to arrange it with them. They're going to know you're there and that you're observing and that you're watching how they're taking the inventory. So it's not a secret count of inventory. You could do something like that, a secret count of inventory. But Davi, that's usually done to catch employee fraud. So you have already arranged that with management, senior management, that you're going to do a surprise midnight inventory count because you don't want to get shot trying to come in at midnight when no one expects you. And generally that's to check to see that the employees aren't really up to something. Okay. But this is more at an overall, higher level, overall entity level type of a consideration. This is more of a management issue. They say, okay, auditor, yeah, we don't have enough staff to count all the inventory at once. Okay, I just gave the answer. Yeah. You want them to count it all at the same time, right? You're going to say no, you have to count it all on Monday, both locations. Bring in some temporary people or something. It all has to be counted at the same time, because if you don't do that, you'll go and you'll observe and count the inventory in San Jose on Monday, and that sound you hear is trucks moving the inventory down Highway 101. So you count the same inventory again in San Francisco on Tuesday. So if they have multiple locations, it has to be a simultaneous count on the inventory. Okay. All right, good. Okay, now what happens? Remember, we're going to test count some of the inventory. So again, the client counts it, we observe them counting, and then we'll come back, not the entire 100%, we'll do some test counts, okay? And so we'll go ahead and we'll put a little tag out there that says what our test count was. I don't know, so say our test count, we counted those, there's 100 of those. It's not $100, that's 100 items, right? Okay, and then the company has also done their counts. Again, we don't count everything. Okay, the company counts most of it, almost all of it, and then we come behind them and count a few things, okay? And so just to use a different number, they say, I don't know, there's 750 of those, whatever. So we've got these little inventory tags, right? And if you want to test the existence assertion, what do? You start from the inventory report and you go and what? Verify those items. If you want to do the completeness, you do what? You start from the completeness assertion, you start from the accounts and you take it back to the inventory sheet. Okay. Okay, good. So what do we have? We have the company counts everything. CPA does a few test counts of some of the things, and then you do what? You have the inventory listing or existence, start with the inventory listing, go back to the test counts, go back to the client counts. For the, that's for existence assertion. For completeness, you do what? You go the other way. You start with the actual physical inventory, you walk it back to the inventory report. And of course, the inventory report reconciles up to the accounting records ultimately, right? Okay. Okay, good. For valuation, allocation, accuracy here, we're going to test the mathematical accuracy of the inventory report. By that meaning, if they say that these things have a cost of, you know, $20 each, and there's 10 of them, 10 items, they should do their extension correctly. That should be $200 if I know how to do my math right on that, right? So you'll check for that, the mathematical accuracy of the inventory report. Inquire about obsolete or damaged goods, okay? Hey, you know, you're telling us that you have a warehouse full of flip phones, and you're saying that each one of those phones is worth, you know, $500. Well, maybe back in 1990, you know, 2000 or something, those phones would have been worth to, you know, $500, whatever. Now, you might be able to sell them to, I see these things when you get old, you know, you're getting old when the TV commercials are geared towards, you know, the stuff that you watch, the TV commercials are geared towards older people. So they have this commercial now where they call it the jitterbug phone, and it's a flip phone and it's real easy to use and stuff, right? So, you know, if they're trying to sell those and they're trying to find a niche in the market, fine, but they're not going to be able to sell those for $500, right? So you would look for obsolete, damaged goods, that sort of thing. Okay. Also, make sure that you're satisfied with overhead rates if they're a manufacturer. Most of the time, you know, and we talk in auditing, we talk from the standpoint of a retail entity. But if you have a manufacturer, then you're going to want to understand some of how they're gathering the direct labor, the direct materials, and then the indirect overhead. Are they using standard rates, et cetera? And this might be an area where it may be very helpful to do some analytical procedures, right? To what extent are they having an unfavorable or favorable variance? Budgeting, maybe there's some problem with their accounting process, right? And you'd be able to find that there. Okay, so you would go and examine variances. Okay. Okay, good. Rights and obligations. Okay, so make sure they have the right to goods. So if something is on hand that is on consignment, then the client should exclude that from their inventory. They're holding something that belongs to someone else and they're simply holding it there on consignment, then you want that excluded from the inventory. Okay, and then when we talk about auditing and disclosure, now we're going to be talking about footnotes. And if you have a client that has somehow pledged their inventory, okay, that's footnotes, they've somehow pledged their inventory, then that needs to be disclosed. Okay, so if there's some sort of pledging or assignment of the inventory. So I borrow some money and I tell the person, well, look, if I don't pay you back, you can take my inventory. Well, that's definitely something that should be properly disclosed. Okay. All right, good. So let's go ahead and let's do another multiple choice question. And let's poll. This one might be a little harder to move the poll out of the way for you to be able to see the question. So you might want to work around that to see if you can move that poll around. What assertion, guys? Let me interrupt you for a second there. What assertion? Please. Okay. Items in the client's inventory listing are valid. Okay, let me lower that poll. In other words, if things listed in that inventory listing, are they valid? What assertion is that? Good. That's going to be the existence assertion, isn't it? Okay, if we're interested that things are valid, then we're talking existence. Now, you got to be careful because they're using the word trace here. And sometimes when we're first studying auditing, we try to understand what's going on. And they usually say vouch for existence, trace for completeness. And so it's very easy to sort of get confused. Well, wait a minute, why does it say trace? It says trace because whoever was writing this question doesn't walk around saying vouch for existence and trace for completeness. They just use the word trace. And so you need to know what you're doing. What assertion are you auditing? If I'm auditing the existence assertion, okay, like Gabe said, then what would be the correct procedure here? And you can go ahead and answer that using the poll.
So it says that we're trying to see if they're valid. So I guess that was the thing that confused me. You want to make sure that the inventory actually is there.
Yeah, it exists. If something is listed on the inventory sheet, is it a valid item? Is it really there? Does it exist? So even though they're not calling out existence here, you need to sort of, sharpen your reading skills here a little bit, or that's not coming out the way I want it to. I'm sure you have excellent reading skills. Twist your mind into the way they're asking this question, which is it's cloaking that they're asking you about existence here.
Okay.
Okay. All right. Most of us are okay. Keep going, guys. A couple more. Okay, I think that's everybody. I always have to remember not to include myself in the count. Okay, and I count as 2 people here. So, okay, good. So what happens? About half of us got it right. Okay, and that was the, by far the, well, I don't know about by far, but it was the one that most of us chose. Okay, most of us got it right. But let's just go through these choices, okay? And so let's take a look. Item A, remember we're talking about existence. Inventory tags noted during the auditor's observation, 2 items listed. Just go back when we go. Oh, they won't let me go back. But that, well, let me close the poll. Then they'll let me go back. Sorry, guys, 1 second. Now I put the poll somewhere where I can't. Now I've done a number on myself. I hid the poll and I can't move the poll so far down that I can't find it now. Let me see. Let me try this. Oh. Excuse me. Okay, so let's just go ahead. Let's take a look back now. What this one is saying is you took the inventory tags and you took them back to the inventory listing. Okay, so in that situation, that's what we saw over here. That's completeness. If you go from the inventory tags back to the listing, that's the completeness assertion. We're trying to test the existence assertion. If there's something that's listed on this inventory sheet, is it valid? Does it exist? So you've got to get some evidence that shows that that thing's really there. And for inventory, the best way to do that is to go and find the thing. Go and find it. Okay, just try to picture yourself doing that. Sometimes with auditing, the best way to try to picture yourself doing that. I've got something listed on this inventory listing. How do I know that thing is there? Okay, it says 1 robot. Okay, let me go find, here it is. It exists, 1 robot, there it is, right? Okay, now after you do that, you might sit there and say, well, this robot is obsolete. They've got a better robot than this now, so they've got a valuation issue. Or, how come its arm doesn't work anymore? This robot is broken, it's damaged. But that's, it becomes a valuation issue. But for existence, it said 1 robot, there it is. Said 2 robots, I only got 1. Why did it say 2 robots? No, that item does not exist. Okay, so ensuring that something is valid, it's listed on there, it really exists. Start from the listing, go and find the thing. And guys, if you're looking at this and saying, how am I ever going to learn all this for all these different accounts? Confirmation of account receivable is the same thing. Confirmation for account receivable is existence. You do what? You find the accounts that you want to confirm on your accounts receivable subsidiary ledger, and you send a letter out that says, yeah, I'm really out there. For this inventory item, I'm finding, there it is. Go from the accounting records to the supporting documentation, the actual physical item, the robot, or a confirmation letter that's coming back saying I owe $25,000. So again, it's about, do you know how to audit the assertions? It's not about each and every account. It's about knowing how to audit the assertions. Okay, so just going back and looking at this question that we were working on. Okay, so it's not A.
And I'm going to be signing an immigration bill that a lot of people don't know about it. You have breaking news, but I'm signing a big immigration bill. It's an executive order. I'm going to do a big executive order. I have the power to do it as president, and I'm going to make DOC a part of it. But we put it in, and we're probably going to then be taking it out. We're working out the legal complexity, but now I'm making a very major immigration bill as an executive order, which someone has given me the power to do it. One of the aspects of the bill.
Okay, thank you. That guy's driving me nuts. Okay, so what happens? We're sitting here. Can you guys still hear
Yeah.
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 I'll do my Donald Trump impersonation for you. So we understand that the more you breathe, the more you can get the coronavirus into your lungs. So do not get coronavirus. Just don't breathe. Don't breathe. You won't get the virus. Okay. So anyway, so that was not me that was talking about DACA and the immigration bill power to do that. Okay, anyway, stop. Okay, let's take a look at B. Inventory tags noted during the auditor's observation to items listed in receiving reports. That is not going to help me with the existence assertion. Just because something's listed in the receiving report doesn't mean they actually received it. Items listed in the inventory listing to inventory tags and the auditor's recorded test count, that's the best evidence. Now I'm going from that inventory listing and I'm going and looking at the thing and I test counted that. So that is auditors, what not only is it, it's auditors direct personal knowledge is the best audit evidence here, right? And it helps us with the completeness assertion. Items listed in receiving reports and vendors invoices to the inventory listing schedule, that might help you with completeness, but to be honest with you, the best thing would be to go from the tags to the listing, from the actual inventory items to the listing. That would be the best procedure there. Okay, so the correct answer here is what? Is C. Most of you got it right, and I think after you look at this a little bit more, you start to get a sense of how to answer these kind of questions. Okay, question. Okay, good. Let's take a look at payroll. Okay, our last of our disbursement cycle set of accounts. Okay, so we have what our last cycle in our disbursement set of accounts. So let's just take a look, and let's take a look at our pen here. Okay, so let's look at our separation of duty. Authorization to employ and pay, that's the human resources department. That's authorization, right? We're going to make sure that someone is properly hired. Supervision is also an authorization. Timekeeping, cost accounting is record keeping. Payroll check preparation is record keeping. And check distribution is record keeping. Now, auditing tends to talk about check distribution. These days, almost everyone's on direct deposit. So as we move through, I'll talk more about how to audit a direct deposit type situation. But looking to see that when I say record keeping for, the actual check distribution is going to be what? Custody, right? You have a paycheck with somebody's name on it, you hand it to them. That's a custody issue. And again, these days with direct deposit, there are some other ways to get around looking at the check distribution because most companies don't hand out physical checks anymore. Okay, so let's just go ahead and take a look at how to look at the internal controls here over payroll. And so we're going to want to make sure that there's segregation of duties between human resources and the payroll distribution. You don't want the situation where someone can what? Create a fictitious employee in the human resources and then also have the ability to what? Distribute or release payroll because they're going to be creating this fictitious employee and taking that check and cashing that check or receiving that direct deposit. So you want separation there. Okay, compare personnel records for each department with actual time cards. So if someone's filling out a time card, they should have been hired by the company. There should be some sort of appropriate human resources records that show that that person was properly on board. Okay, observed distribution. If you had such a thing these days on an unannounced basis, so that you're going to catch the employee that's not there. Where's Bill Jones? Bill Jones, Bill Jones. Oh, he's not here today. I'll take his check. No, the auditor is going to follow up to make sure there's actually a Bill Jones, right? Observe the use of time clocks. If direct deposit is used, if, I mean, everybody uses direct deposit. So what you would do is you look to see what the direct deposit authorization was on that. And then you would say, okay, can we please see the record of where money was distributed? And the employee is going to put the routing number that they want that money to go to. And then you can look to see that there was some sort of acknowledgement back from the employee's bank that says that that amount was deposited to that routing number. That's probably how you would do the observation of the check distribution in a direct deposit type of a situation, which is what you have most of these days. And then you're going to want to make sure that there are proper general and application controls over the payroll. So there should be, passwords to access the payroll records. That would be more of a general control. There should be, if there's some sort of limit check on any one payroll check, that would be an application control, right? Payroll checks are broadly distributed for a company, and so you generally are going to want to make sure payroll distributions are fairly broad. So you probably want to have some sort of limit on a payroll check, right? The top person in the company makes $10 million, then why would you ever have a payroll check that goes out in excess of 10 million, let's say, or whatever it is? It's probably going to be 10 million. That'd be their entire year's salary. You'd have some reasonable check on the total amount of the payroll distribution that should go out in any pay period. And that would be an example of an application control over payroll. A general control would be, password would be an example of a general control. Okay. Okay, good. So you do all these different, you have all these different internal controls, and then you're going to go through and do your audit procedures over the assertions, valuation, recalculate any year-end accruals. Completeness, you're going to do what? You're going to take a sample of time cards and see if that's properly recorded in the payroll register, right? Going from the time cards to the accounting records. Completeness. Existence, you'll go ahead and go the other way. You'll take a look at the time cards right here and see that you'll start with what's recorded in the payroll register. You'll go and find the time cards that line up to that. Okay, so payroll is really a pretty easy thing to audit. It's simply doing what? Making sure that you have complete data, existence, taking that payroll register, finding the time cards for the for the existence assertion, for completeness, going from the time cards to the payroll register, and do some checking of year-end accruals, and then looking at those appropriate internal controls. Okay. Question. Put that a little too fast. Okay, good. Let's do this then. I promised you I would show you the slide that you are going to sleep with under your pillow prior to the exam. And I said that's chapter 8.
Professor, I have a question. Nowadays, everybody is working from home. So how one can keep record of that?
If everyone's working from home, how can you keep record that they're actually working, the hours that they're putting down?
Yes.
Well, I don't think you can. Then what are you going to do? Go to their house? I reckon if, for example, I'll give you an example in this class. I can look to see how often you log into e-learning, and how much time you spend in e-learning. So I would imagine, and some people say, well, you can use that for attendance. Okay. I do it more on an exception basis. If I see that someone never logged into the class, I might send an email saying, hey, what's that? How come you never logged into the class, right? That would be a good way that there should be some sort of log in the system that shows when people logged into the system, when they logged out of the system. Okay, I would imagine if they're working remotely, they're probably having to access some system, right? I mean, if they're working remotely, they're certainly not, moving things around at the office because they're working remotely. So probably they would be logging in, and you could check their login activity and see if that matches what's on the payroll.
Okay, thank you.
Yeah, it's pretty tough, but I would imagine that in a service type environment, which is what's going to allow you to work remotely. You know, we don't get as hopped up on how many hours did that person put down and did they actually work those hours. It's more based on what did they produce, right? And usually someone's going to get fired if they don't meet their deadlines and whatnot. And so it would be just more of a matter of what did they put down on their time card, and was that properly entered into the payroll register without so much did they actually do the work that they were supposed to be doing in a service type of a situation, right? Okay, good. So let's go ahead and let's just go, and I want to just